Good morning, children. Welcome to the part 3 of the chapter Meaning, Objectives, and Terminology of Accounting. In the previous part 2 of the video of this chapter, we started off with the basic accounting terms and we discussed a number of terms related to your accounting. For example, drawings, debit, credit, debtors, creditors, discount, and so on. In this video as well, we are going to continue with the same topic, the basic accounting terms, but the two terms which we are going to study in this part is very important. The two words are assets and liabilities. And in this video, we are going to study them in detail, their meaning, their types, and the meaning of their types as well. So let us begin. Another word or another term which we need to understand is assets. Now, what is assets? Assets means anything which is in the possession means it is with, or is the property of a business enterprise, including the amounts due to it from others, is called an asset. So what is asset? Asset means anything which is in the possession of a business enterprise. Possession means that it is with the business enterprise, or it is basically the property of a business, and it also includes the amounts which is due to the business from others. For example, debtors. We have discussed the meaning of debtors in the previous video. So debtors is an asset for the business, because debtors are those persons or institution who have purchased the goods or taken the services on credit and they have still not made the payment. So in simple words, we can say that assets means anything which will enable the business to get a cash or any cash benefit in the future. This is something which the business owns and uses it in the business activity. It can be converted into cash, or at least some benefit in cash value or in monetary value can be obtained from assets in the near future. And the formula for asset is basically liabilities plus capital. In the previous video, we have done the formula for capital, which was assets minus liability. And if we apply the mathematics, then asset is equal to liabilities plus capital. This formula is given when you will get your PDF notes. Now we are starting with the very important part, that is the classification of assets, basically the types of assets. So all these types of assets I'm going to explain it to you here, and the examples are very well written here, and the written all the explanation regarding this will be given to you by way of PDF notes. So let us begin with the types of assets or classification of assets. The first type of asset is the fixed assets. As the name suggests, fixed means it is not changing. So basically fixed assets refers to those assets, those property of the business which are held for continued use in the business for the purpose of producing goods or services. Basically, fixed assets are those assets or those things or those property which is owned by the business and they are used by the business for the production of goods and services on a regular basis, and these assets are not meant for resale. These assets are not purchased for reselling them. For example, land and building, plant and machinery, etc. The other type of asset is current asset. Current assets are basically those assets which are meant for resale. Basically, these assets are meant for resale, means these assets are purchased so that they can be sold again. For example, goods. Goods or stock is a part of current asset because these goods are purchased so that it can be sold to the ultimate customers or consumers. So current assets are those assets which are meant for resale or which the management would want to convert into cash within 1 year. Very important. Current assets are those assets which can be converted into cash within 1 year, within a short period, and that short period here is 1 year. It will not take more than 1 year to be converted into cash, and therefore these assets are also known as short lived or active assets, because these assets are very of short term nature, because these can be converted into cash within 1 year. Therefore these are also known as short lived or active assets. For example, debtors, bills receivable, prepaid expenses, stock, etc., because all these assets are converted into cash within 1 year. Then the third type of asset is tangible assets. The word tangible means which can be seen and touched. So those assets which can be seen and touched are known as tangible assets. For example, land, building, plant, etc. So we can touch land, building, plant, machinery, furniture, tools, etc. We can touch them, we can see them. Therefore, they are considered to be the tangible asset. Whereas intangible assets are just the opposite. Intangible assets Intangible assets are those assets which cannot be seen or touched. The benefit of this can only be felt. For example, goodwill, that is the reputation of a business, patents, prepaid expenses, because these are expenses paid in advance, etc. Other type of asset is liquid assets. Liquid assets are basically those assets which can be converted into cash very soon, even in less than 1 year. Very soon, maybe 3 months or 4 months, like that. It doesn't take even 1 year. These are the assets which are either in the form of cash itself, or it can be quickly converted into cash. For example, bills receivable, debtors, short term investments, accrued income. Accrued income means the outstanding income. That means you have performed the work, you have given the service, but you just have to receive the income. And if prepaid expenses and closing stock, if we deduct prepaid expenses and closing stock from current asset, the rest of the current asset or the balance will be the liquid asset. So that means all current assets except prepaid expenses and closing stock are considered as current, or we can say the liquid assets. Then the next type of asset is fictitious or nominal assets. So these are the assets only for the namesake. They cannot be converted into cash. They cannot give any cash, but they are just shown on the asset side. So these are the assets which cannot be realized in cash, or no further benefit can be derived from these assets. For example, debit balance of profit and loss account, and the expenditure which is yet not written off, such as advertisement expenses, etc. These are only shown on the asset side only for the purpose of transferring them to the profit and loss account gradually over a period of time. Because what happens when a huge amount of expense or expenditure is incurred, is paid at once, it cannot be written off in the same year, because it will be huge amount. So it is decided, it is determined that for how many years the benefit will continue, so it is written off equally. For example, if a business launches a new product, and if it spends 10 lakh rupees on the advertisement of launching a new product, and it is expected that the amount of 10 lakh rupees spent on advertisement will give the benefit up to 10 years. So this 10 lakh rupees cannot be shown in 1 year only, it will be divided, it will be shown over 10 years. That means 1 lakh each year. So 1 lakh will be shown in the profit and loss account as the expense of the current year, and the remaining 9 lakh, or the whatever the balance will be left each year, that will be shown on the asset side of the balance sheet as the fictitious asset. Then the another type of asset is wasting assets. These are basically those assets which keep on depleting, which keeps on decreasing with the passage of time, with the usage, and the time comes when it becomes zero. So these wasting assets are consumed through being worked or used, such as mines. As soon as all the minerals have been extracted, if we take the example of mines, coal mine or anything, any mine, as soon as all the minerals have been extracted from the mine becomes valueless, zero. It also includes assets which get exhausted with the lapse of time, with the passage of time. That means any asset which is for a fixed time period, for example your license for your business or anything, So that license has a expiry period. You have to get it renewed after the expiry of the particular period. So that is also considered as a wasting asset, because with the passage of time its value will become null and void. So it also includes those assets which gets exhausted with the lapse of time, such as patents, trademarks, leasehold properties, etc., because these are associated with a period of time. So wasting assets are those assets which keeps on depleting with the passage of time and with the usage. For example, mines, oil wells, patents, trademarks, leasehold properties, etc. All these assets are explained in detail in written form in your PDF notes. Now we are starting with another very important term which is used in accounting, and that is liability. So liability is what? Liability is the amount which the firm owes to outsiders. That means the firm or the business is liable to pay it to the outsiders, accepting the amount owed to the proprietor. And we know that amount which is owed to the proprietor is known as capital. So capital is no doubt is a kind of liability, but it is treated separately. And liability is equal to assets minus capital. So liability is what? It is the amount which is owed, OWED, or which is owed by the firm to the outsiders, or which the firm owes to the outsiders. Maybe a firm has taken loan from somebody or purchased anything on credit and it has to make the payment, etc. Now the classification of liabilities or the types of liabilities. So the first type of liability is the internal liability. The word internal means within. So internal liabilities means those liabilities or those amounts which a business entity has to pay to the proprietor or the owner. So amount for which the firm is liable to pay to the owners is known as internal liabilities, such as capital or accumulated profits. Accumulated profits means the profits which is retained in the business. It is not of the business, it is of the owner, so it has to be paid back to the owner. And capital is also the amount invested by the owner in the business, so this amount has to be returned to the owner. Then the second type of liability is external liabilities. It is just the opposite of internal liabilities. The word external means outside. So all those amounts which a business entity has to pay to the outsiders are known as external liabilities. For example, creditors, bills payable, loans, etc. Then the third type of liability is long-term liabilities, or it is also known as fixed liabilities. So as we have learned that fixed assets cannot be converted into cash within 1 year, in the similar manner, long-term liabilities or fixed liabilities are those liabilities which fall due for payment in a relatively long period. That means these liabilities or these amounts are to be repaid back after 1 year. For example, long-term loans, debentures, etc. So those amount which the business has taken for long term, that means it has to be paid after 1 year. So that is considered to be long-term liabilities or fixed liabilities. Then the next type of liability is the current liabilities. So current liabilities, as we have learned, current asset. What are current assets? Current assets are those assets which can be converted into cash within 1 year. In the similar manner, current liabilities are those liabilities which are to be repaid within 1 year. So current liabilities are the liabilities which are to be paid in near future, normally within 1 year. For example, bank overdraft, creditors, bills payable, outstanding expenses, etc. And the last type of liability is contingent liabilities. The word contingent means which is not certain. It is dependent on some event. It may happen, it may not happen. So in the similar manner, contingent liabilities are not the actual liabilities on the date of balance sheet. When we prepare the balance sheet, so the liabilities which are appearing as the contingent liabilities are not the real liabilities, but it may become payable only on the happening of some specific event. That means if an event occurs, then only it will become a real liability, otherwise it will not be a liability. For example, bills discounted but not matured, Or another example can be a guarantee given, for example, on behalf of somebody. For example, if I am taking loan from a bank for rupees, let's say 5 lakh, and I have presented you as my guarantor that if I am not able to pay back the amount of loan, then in that case you will pay the amount on my behalf, because you have given the guarantee from my side. So for me, it is an actual liability because I have to pay it back. But for you, it is a contingent liability. It will become your real liability only and only if I fail to make the payment. Otherwise, no. So these are considered to be the contingent liabilities. So I hope the terms discussed in this video and the previous video are clear to you, children. Just go through the video once again. Go through the terms once again. Remember the examples, learn the meaning, children. Now this is the assignment which is based on this part. Both these questions are basically the long questions. You have to answer them in detail. Definitely you can take the book from the video or your book or the notes which will be given to you. You have to answer the following questions in your register. What do you mean by assets? Briefly explain its types. So you will write the meaning of asset in this, that asset means anything which will enable the firm to get a cash or benefit in future. Then you will explain its types. For example, you will explain fixed assets, that fixed assets are those assets which are held for continued use in the business for the purpose of producing goods or services and are not meant for resale. You also have to give at least one or two examples of each. So for example, land and building, plant and machinery, etc. Then the second type of asset, current asset, that means those assets which are meant for resale or which the management would want to convert into cash within 1 year. For example, debtors, bills receivable, etc. Then the third type of asset which you need to explain is tangible assets and intangible assets. Tangible assets are those assets which can be seen and touched, for example, land, building, plant, etc. Intangible assets are those assets which do not have a physical existence, basically which cannot be seen or touched, for example, goodwill, patents, prepaid expenses, etc. Then another type of asset which you will explain is liquid assets. That means liquid assets are those assets which can be converted into cash within very short time. And if we deduct, you please mention that if we deduct prepaid expenses and closing stock from the current asset, we will get the balance as liquid asset. Then you will explain the fictitious or nominal assets. That means these are the assets which cannot be realized in cash or no further benefit can be derived from these assets. For example, advertisement expenses, not written off, debit balance of profit and loss account, etc. And the last type of asset which you will explain is the wasting asset. That means these are consumed through being worked or used. For example, mines, oil wells, patents, etc. Then question number 2, what do you mean by liabilities? Briefly explain its types. So here you will first of all explain the meaning of liability. You will explain that liability is the amount which the firm owes to outsiders excepting the amount owed to the proprietor. Then you will explain its types. First of all, you will explain the internal liabilities. That means all amounts which a business entity has to pay to the proprietor or owners are internal liabilities, for example, capital, accumulated profits. Then you will explain the external liabilities. You will write the meaning that all amounts which a business entity has to pay to outsiders are known as external liabilities, for example, creditors, bills payable, etc. Then thirdly, you will explain long-term liabilities or fixed liabilities. These are the liabilities which fall due for payment in a relatively long period, that is normally more than 1 year. For example, long-term loans, debentures, etc. Then you will explain the fourth type of liability, that is current liabilities, and you will write the meaning as these are the liabilities which are to be paid in near future, normally within 1 year. For example, bank overdraft, creditors, bills payable, etc. And the last type of liability which you will explain is the contingent liabilities. You will write the meaning that these are not the actual liabilities on the date of balance sheet but may become payable only on the happening of some specific event, for example bills discounted but not matured, etc. So I hope the question and answer is clear to you children. You need to write them in your register. Again I'm saying go through all the parts of this chapter, because these videos in this chapter will provide a basis when you will be doing the practical chapter. So go through the video once again children, revise the topics, revise the terms, do the learning part, and also complete the written work in your register. Thank you children. In the upcoming video we'll be moving further with the chapter. Thank you children, take care.